We should have let more things fail back in 2008 that needed to fail. We should have run our balance sheet off sooner. We only got to about $2.5 trillion before they started to raise it back up again. This beast just keeps getting bigger. It's like a python that just keeps eating more and more. And pretty soon it's going to destroy itself.
Please join us for our next live stream, Sunday, April 9th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, April 9th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team at Silver Bullion, where we want you to truly secure your wealth. Dana Samuelson, president of the American Gold Exchange, joins us today. Dana has some 42 years of experience in the precious metal space, including bullion and rare U.S. gold and silver coins. His company, the American Gold Exchange, has enjoyed endorsements of numerous national newsletter writers and has been quoted in Forbes and Market Watch, along with appearing on Fox Business. And we're delighted to have Dana join us here today. It's time to saddle up and silver up for Dana Samuelson. Dana, welcome to SBTV. How are you doing?
I'm doing great, Patrick. Thank you for having me. Glad to be here.
Glad to have you on. First time we get to speak with you, so I'm looking forward to it. Dana, you are the president of the American Gold Exchange. Can you tell us a little about the American Gold Exchange?
Yes, we're a national mail order physical precious metals dealer and vintage U.S. gold and silver and European gold coin dealership. I've been in the business for 43 years. I got my start in 1980 following the end of the last big boom. I worked for a gentleman by the name of James Blanchard for 12 years, where I really cut my teeth in the industry. Jim is the man that's responsible for the private re-legalization of gold ownership in the United States in 1974. And I worked for Jim in the 1980s and early 1990s. He had the largest mail order coin company in the world at that time. And I ended up going off on my own and starting American Gold Exchange in 1998. And we focus on modern, sovereign minted gold and silver bullion coins, a little bit of platinum and palladium too. We also do some refinery minted bars. And I'm also a vintage pre-1933 U.S. gold coin expert. I'm a member of the Professional Numismatists Guild, which is the leading organization of rare coin dealers in the United States. And I was president of the P&G for 2 years in 2016 and 2017. So I've got a lot of expertise in the physical hard asset arena in the United States. Very well known. Been around a long time.
That physical hard asset being gold. So your colleague, he was trying to persuade Congress, because I think it was Ford at that time that actually enabled gold to go back into people's hands.
Right. So gold ownership was made illegal in 1933 under President Roosevelt when he confiscated the gold. So U.S. citizens were no longer allowed to own physical gold. Collector coins that had value above their gold value of 15% or more were exempt from that confiscation. A lot of our old gold coins went to Europe in trade payments and stayed there for decades. They're coming back now. But when we went off the gold standard in 1971 under Richard Nixon, Jim understood that the dollar would lose purchasing power and value as a fiat currency. So he lobbied Congress and created what he called the National Committee for Monetary Reform. Had thousands of members who lobbied to have gold ownership re-legalized. And that was accomplished in 1974, as I said. And then all those people asked Jim, well, where do we buy it now? And Jim said, well, I'll sell it to you. So by default, he started the Precious Metals Coin Company. And in 1980, inflation took off in the late 70s. The gold price rocketed higher, and at his investment conference in 1980, he had 10,000 people, which is a gigantic audience. And I never thought I'd meet another guy like Jim Blanchard until I met and became friends with Robert Kiyosaki, who has the same philosophy as Jim. Robert's been collecting gold since the early 70s when his rich dad told him the dollar's going to lose purchasing power. So I've been blessed to know and be friends with two giants who are gold bugs.
Do you think many people understand this? Do you think that they can put together the pieces and understand that the currency is really losing purchasing power? The currency is really being devalued, debased, and countries actually want to move away from the same currency.
I don't think most Americans really get it, to be honest with you. Some do. We tend to measure everything in dollars, and it's not that the dollar's losing value, it's that everything's going up in price relative to the dollar. Now, over the last 6, 7, 8 years with inflation at 2% in the United States, you don't really feel it. But when we suddenly go through an inflationary phase like we've been shocked with in the last year and a half, and everything costs a lot more, people start to realize, oh, hey, the dollar can lose purchasing power, but I still think they get the equation upside down. It's not really that gold and silver are that much more valuable. It's not that the dollar is that much less valuable. If you measure things in gold over time, gold holds its purchasing power. Silver holds its purchasing power, while fiat currencies buy less and less. And the last year or two has been a real eye-opener for a lot of Americans for this regard.
And when you talk to some of your customers, what are some of the reasons, such as this, that you hear them tell you why they are buying these various forms of precious metals?
Well, a lot of our customers are very intelligent people. They're small business owners. They're C-level executives. They see the bigger picture. They live it. They run businesses, either small or large, and they get the big picture. It's mostly about the debt in the U.S. taking off. From 1793 to 1994, that's 200 years, we got to $5 trillion in debt. And now in the last 28 years, we've multiplied that sixfold. And when we go through these debt shocks or or an economic crisis, that has really spurred most people to react. It's not that we teach this in school, or we really, teach sound money. It's that there are shocks to the system that have spurred people to really learn how to buy precious metals. We trained a lot of people during the great financial crisis how to buy gold and silver that had never bought it before. So when we got into the COVID debt surge and economic crisis recently, people reacted much more quickly. And we're seeing it again now that we're having a banking shock here in the U.S. So we get these waves of buyers that are bigger and bigger, and it's nice to see, but it makes it a little challenging to run a physical precious metals business when demand is, relatively modest, and all of a sudden it skyrockets for an extended period of time. But we're seasoned pros, so we've handled it pretty well.
Yeah, yes, you have. I mean, we've seen that the same scenario here in Asia as well, where all of a sudden it'll just pick up, and you'll really see high demand there. But with your company, American Gold Exchange, I noticed your selection of junk silver, my favorite, um, including dimes. And I know many people watching this, they are of the belief that they may one day have to use their silver coin as money, perhaps may have to use their gold as well. Do you think silver and gold will once again have some sort of monetary element to them, whether for barter or for perhaps backing a currency once again?
Well, there's been so much wealth creation over the last 30 years. Computers really enabled traders to accelerate the amount of trading they could do, speculating they could do. And as we get more experience, the amount of money that's been created, made, earned, and the amount of money that's been printed is taking us kind of off the scale compared to where we've been for thousands of years when gold and silver were currency, from ancient times all the way to the 1930s in gold, and silver all the way to the 1960s and 70s. Jim Rickards, who I know you're well aware of, thinks if we ever have to go back to a gold standard of some kind, the gold price will go to $10,000 an ounce. I don't think that there's enough gold to back the amount of currency that's out there in a reasonable manner. I do think that if the Chinese want the yuan to be accepted, they may partially back it with gold or other commodities because they don't have the transparency in their markets. They don't have a credit market, a bond market like we have. And they're going to need something that people can trust that's behind the currency if they really want it to challenge the dollar as the world's reserve currency. But I don't think that there's really I don't think it's going to be practical for gold to be money again, except perhaps on the black market. I do think if things go really badly, we'll see people wanting to barter with gold or silver in particular. Silver's more spending money in a crisis. Gold is truly portable, transferable wealth. It's easy because you can hold, 100 ounces of gold is the size of a paperback novel. It weighs about 8 pounds. It's worth $200,000. You can put it in your pocket and carry it around. No one will know you have it. If you had $200,000 worth of silver, it'd take about 3 or 4 of guys like you and me to move it around and be a gigantic pile. So silver's not practical to transport or store real wealth, but it's practical for a daily exchange basis. Now, when I started my company in 1998, and I was just really trying to make a name for myself, I created what I call the hard money pack, so people could have a little hard money for Y2K in case the computers went down. And it was U.S. silver dimes and quarters, and British gold sovereigns and Swiss 20 francs, or U.S. 10th ounce and quarter ounce gold eagles. And we sold a ton of them. And so people ask me, if I need to barter, what do I do? I said, well, we're all trading by the seat of our pants and our own negotiating ability. But I think if you want something and you have silver and somebody else has paper money that's, burning because of high inflation or something, you're going to go to the front of the line and you're going to get what that seller has first. That's really where I think silver comes into play in a situation where there's a really destabilization of the currency like we've seen, many times around the world when fiat currencies have gone bad due to too much debt.
If you're enjoying this interview with Dana Samuelson and I, please consider subscribing to our YouTube channel. And if you'd like to learn more about wealth protection, please do visit us at www.silverbullion.com.sg. Yeah, I completely agree there. How important is it to understand what a store of value like gold, in some cases like silver, how important is it to understand what they are as a store of value and can do as it looks like we are nearing the end and a challenge to a US dollar hegemony?
Oh, it's extremely important. Most U.S. citizens don't get it because the U.S. dollar is the world's reserve currency. It gives us exorbitant privilege. What most countries experience are not only commodity prices changing, but their currency prices, values changing relative to the dollar. So they can get a double shock. If commodity prices go up and their currencies drop in value at the same time, it's a double whammy. And that's what happened around the world last year when inflation hit and the dollar soared because money from around the world was looking for safe haven. We had higher interest rates here. So if you had money in Japan or Europe or Great Britain, it came into the U.S., the dollar was the gateway. It buoyed the dollar way up. And also we had inflation, so commodity prices were higher too. So you're not only paying an inflation rate in England or the Eurozone or Japan, now you're losing money because a lot of these things are priced in dollars as well. Now, if we lose that dollar as the world's reserve currency and things are priced in other currencies, then U.S. citizens could be exposed to the same double whammy shock that we don't get. We're insulated by having the dollar as the world's reserve currency. And most people here in the U.S. don't get it. Some do. And that's why having some gold and silver, most economists will say, or tax advisors, financial planners will say 5-10% of your assets in gold and silver is important because you have precious metals that don't have counterparty risk. They're not simultaneously someone else's liability, like a currency is, or a stock is, or a mortgage is, right? They're portable. They're transferable. They're immediately liquid. You present them to any reasonable buyer and you'll get paid right away. There's no settlement time. During the great financial crisis, a lot of people that were leveraged in real estate had their positions broken because they couldn't refinance, right? And we're going through the same kind of a shock now with rising interest rates. So we'll talk about that a little later, I would imagine. But when you have the cost of money change dramatically and standards for lending change, it can create shocks you don't see coming, which is why having some precious metals is a good thing, because you always have portable, transferable wealth. I got into this business because my brother got me my first job working in a vault because I could be trusted. His first job in 1974 was going to a Vietnamese relocation camp in Arkansas, where Vietnamese that were fleeing Vietnam because of the end of the war there were coming to the U.S. to find a new life here. They carried gold tails, like bookmarks of gold, sewn into their clothes. That's how they carried their money out of the country. And he bought the gold from them and trade that money into dollars so they could get started here. But we've never had that kind of a problem like they had in Germany in the following World War I with rampant inflation, or currency crisis like Venezuela's had. So most U.S. citizens are too addicted to their phones these days to really pay attention to much that really matters, sadly. And we're doing a disservice to our kids and our future with our debt, and we're not teaching them the fundamental things. And gold and silver have always, historically, been a key part of a financial asset portfolio.
Yeah, I completely agree. Again, those stories about Vietnam and the refugees, amazing, sad but amazing stories. And it's not just the ones that were trying to get on the boats where the captains, people had wads of money, but the captains were taking people that had gold, that had precious metals with them. They were the ones getting on the boats. And it even went over into the overland refugees that had to travel across over to Thailand. They were taking gold with them as well in order to stay alive or gain favor. So gold is definitely something that can save you financially, in some cases save your life as well. But moving on, we are seeing this new shock, this new shock of SVB and banks, a sort of a ripple effect. And Congress wants to figure out what happened with SVB and how to prevent it from happening again, maybe in our lifetime, as they like to say. Dana, in your opinion, what is happening with the banking system right now?
Well, the surge in interest rates, let's back up a little bit. The ground was laid for this between 2012, 2013, and 2018, when our interest rates were zero for so long here in the U.S. It allowed companies to take on debt that they normally wouldn't take on and risks that they normally wouldn't. We had a mild interest rate cycle, hiking cycle in between 2016 and 2018. We got our rates to 2.5%, and then we had to cave back in, right? Go back to zero when COVID hit. And now we had another debt explosion, 20%. Our debt went from 23 trillion to 31 trillion in 2 years here in the U.S. And that caused inflation. All that money being pushed into the system in a supply shock created this inflation that we're going through now. And the Fed has been slow to react. They were behind the curve in trying to contain inflation, and now they're reacting too much too fast, some say, and things are starting to break. You have a whole generation or more of traders, speculators, investors, never been in an inflation environment like this before where rates are rising so hard so fast. I lived the last one in the 70s. I was a younger man then. I was in high school and college and just getting my start, but I remember. And people aren't trained for this. So what happened with SVB was they had no risk management. Their business exploded because of COVID, so their deposits jumped from 30 billion to 70 billion to 170 billion over a 3-year period. They had to take all that money and put it somewhere safe. So they put it into long-term treasuries, at 1% yield. And now the Fed the Fed telegraphs what they're going to do. They tell you ahead of time. It's easy to see the course that they're going to take. And they raised rates dramatically, but SVB had no risk management of any kind. So when their bond portfolio took a sudden turn for the worse, their bond values dropped because you get higher yield on other bonds, yours are worth less. That put their portfolio upside down to unrealized losses. And then a lot of that tech money that they attracted due to the COVID boom contracted, and they needed to raise capital. They had to sell their bonds. So suddenly they're in a really tight cash flow position because their risk management was horrible. They didn't hedge or rotate their bonds into other higher yielding bonds and take some of the losses along the way and reposition themselves better. Well, there's a lot of other companies that have done that. According to Nouriel Roubini, there's $2.2 trillion worth of assets that are securities or bonds out there among banks and other hedge funds that have about 620 billion of losses, 28% that are unrealized as of yet. And this is a we talk about banks being too big to fail. This is a problem that's too big to solve. It really is, right? Because you can't print enough money without destroying the currency to bail everybody out. So I just went on a bit of a rant.
No, that's fine. I go on those too. They're fun. Those rants can be fun sometimes.
But we have fundamental systemic risk now that has been brought into the system because the Fed is trying to contain inflation. And the fundamental problem is the Fed knows that during the last inflationary cycle in the late 60s to 1980, we had 3 waves of inflation, with the second wave and the third wave being bigger than the first and the second. And if they'd only contained it during the first wave, that second and third wave may not have come larger and bigger and more shocking. So they're really trying desperately to contain inflation in this first wave now. But here they're caught between a rock and a hard place right now because they've raised rates to the point where things are starting to break. And if they don't contain inflation now, they can't really be more aggressive in raising rates higher because more things will break and the system will potentially come undone. We had a week here in the U.S. 3 weeks ago where people were rushing to pull their money out of banks, mostly small banks moving into bigger banks because the bigger banks are perceived as too big to fail. It was a crisis of confidence. If that crisis of confidence had persisted for another week or two into this week, the system could literally become undone. Literally. So that's why the Fed threw everything they could at the problem. We're going to pay the uninsured depositors their money. $150 billion worth. We're going to increase the swaps between other countries from a weekly basis to a daily basis to put liquidity into the system. Now, they're doing QT. They took about $700 billion back over the last 6 months, but they just put $300 billion back in to reliquify things. So every time we have a problem, now the Fed comes to the rescue. We're not letting things fail the way they should have in the last cycle or this cycle, which lets the steam out of the equation. Businesses are supposed to fail if they're not doing well. And right now, if the Fed has to raise rates further, they'll raise them a little bit more, but they really can't go a lot farther without creating bigger problems. And they don't have the ammo to kill the beast if the problem persists. So inflation. So it's really a conundrum right now of how this is all going to work out, which is why we're seeing a big surge in precious metal sales. People are getting, the people that are in the know that see the problem, they get it. They're like, I need to have a hedge just in case as an insurance policy. That's really what precious metals are for. And now's the time, I think more than ever, that people should have some.
Absolutely agree. Once again, with what you're saying, it's interesting because if you ever take a look at the Fed balance sheet, you see the tail end of that chart starting to move north again, and it looks like it's getting pretty close to where it was before they started tapering. And then again, if you look at the effective funds rate, you see that they are right where they were before they really had to cut rates again. So, I mean, Dana, what does the Fed do? I mean, are they going to go back into QE, save the system that, frankly speaking, may really be dead at this point, or do they, try to take care of inflation? I mean, if they do continue to go back into QE, they run the risk of inflation running once again. So, I mean, what does the Fed do at this point?
Right, they're really stuck. They really are stuck. It took Paul Volcker getting rates up to 18% in 1981 to kill inflation on the last cycle. And what are we at now? 5%, right? So they're stuck. They're stuck. Now, Paul Volcker, I'm sorry, Jerome Powell has said that if we go back into an economic slowdown, we know what we need to do. We have the tools. So he's saying, hey, we'll go back to lower interest rates, and potentially QE again. But that has the potential to explode inflation, to truly wreck the dollar. Because we cannot continue to take on debt at the levels that we have, in it ad infinitum, in perpetuity. We can't do it. At some point in time, it just becomes unpayable and the system becomes untenable. People know that. So, for example, our debt service, it was $500 billion a year ago to service our $28 trillion debt. Now at $31 trillion, which is not that much more, but interest rates more than double, our interest payment on our debt is going to be $1 trillion, right? Almost as much as the military spending. And our debt to GDP ratio is about 120% now. So anytime a country has a debt to GDP ratio of 100% or more for 5 years or more, those economies don't grow at more than about 2 or 3% a year, because money that would be spent to grow the economy, research and development, infrastructure spending, goes to debt service instead. So if we had $1 worth of debt, in 1995 or 2000, that would get us about 75 cents worth of growth. $1 worth of debt in 2010 got us about 50 cents worth of growth. $1 worth of debt today gets us about 25 cents worth of new growth. It's diminishing returns. And this is going to continue to narrow and get worse. And it's going to undermine the purchasing power of the dollar versus, commodities. And it has the potential to create more inflationary waves if the Fed really has to go the other way, which is the only thing they really can do other than hold rates high and just let things break and hope the dust settles in their favor in the long term. That's really the only choices they have.
Yeah, Dana, do you think with what we are seeing today, is it still spillover of what we had in 2008?
Oh, absolutely, because we're following the same policies. We should have let more things fail back in 2008 that needed to fail. We should not have had zero interest rates for as long as we did following the great financial crisis. We should have run our balance sheet off sooner and gotten it back down to a manageable level. From $3 trillion, we only got down, what did we get? I'm trying to remember the numbers. We only got to about $2.5 trillion before they started to raise it back up again. They run the balance sheet up, they bring it down a little. They run it up, they bring it down a little. This beast just keeps getting bigger. It's like a python that just keeps eating more and more. And pretty soon it's going to destroy itself. So I wish I had a better analogy. But yeah, businesses in the 80s and 90s, when the economic cycle turned, things failed. We had, companies go out of business. We had currencies lose value. We had prices go up. I mean, that's the economic cycle. That takes the steam out of the equation. And now we're trying to save everybody all the time, which is impossible. At some point in time, you blow the bubble up so big it blows up and affects everyone. And that's where we're at now.
With what's going on, do you think the Fed has any chance of getting things back under control, or do you see more trouble ahead?
Well, there is a potential for the economy to slow down enough where inflation will mitigate. But we're also in a bigger global picture, which is less inclined for harmonious business activity than we've been in before. We have a bifurcation, east and west. The Ukrainian war has created problems that we didn't expect to have, and now we have, we weaponize the dollar, to take sides. China is coming up. India's coming up. Russia and China are siding and doing transactions in their own currency. Between 2014 and 2018, we had a just-in-time inventory system in the world that was humming very efficiently. And then the Trump tariffs fractured that a bit, and then COVID broke it. And now we've got this bifurcation over East versus West, and it's going to be worse. So we're not going to have a harmonious supply chain like we had in the past. And that's going to contribute to more systemic inflation at a higher level. It could be lower, but at a higher basal level overall. And the economy here in the U.S. could contract. It should. It's not doing that yet. It's amazing that we haven't gone into a recession already. Consumers are 70% of our economy, the spending. And, consumers here in the U.S. are getting tapped out. The savings rate's at its lowest level it's been in decades. And credit card rates, balances are as high as they've been at record highs. So this is a situation that can't continue. And the interest on that credit card debt is at record highs now. So at some point in time, I think we're going to probably go from, the economy's pretty good, to we hit a wall and things just stop. And if that happens, that will actually be good for inflation because it'll let things calm down that way. And it might give the Fed some breathing room. I really think that's our only choice towards helping the U.S. economy heal from this inflationary and high interest rate bout. But it's going to be painful. It will be painful for most people, especially the lower and lower middle class. Lower class, lower middle class.
And I guess as we see these things start to unfold, especially with the inflation, if people should really move back into gold and silver, they get aware of it, they start moving to it. Is there enough supply of gold and silver for everyone to help them get through these tough times ahead?
Potentially, no. We're already back into another silver squeeze here in the physical inventory in the United States, and I would imagine it's global. So things, when COVID hit, we had a big explosion of buyers that lasted for about 30 months, 2.5 years. And it really only started to settle down last November, December, 3-4 months ago. So for January, February, and into early March here in the U.S., physical sales of precious metals were lower. Inventories finally started to catch up and exceed demand. And premiums came back down to normal levels, especially for physical silver, where they hadn't been for 2 years. And now we have, 1 week of really serious buying, which has got some flow through into a second and third week. And now we've got on-the-shelf inventories have been wiped out. We're back to allocations from the various mints and refineries. We're seeing delayed deliveries and premium increases creeping up. And that's only a couple weeks worth of sales for silver. Gold tends to be a little bit more plentiful because there's not as much attrition for gold as there is for silver, which sees use in industry, electric vehicles, solar panels. And silver is more problematic because it takes a lot more silver ounces to equal the same dollar amount as an ounce of gold. 84 ounces of silver. So if someone wants to spend an equal amount of silver in dollars and gold, they get 1 ounce of gold and 84 ounces of silver. So that tends to put pressure on the volume of silver. And we're seeing the COMEX and London Bullion Market Association warehouses being severely depleted of physical silver because of these waves over the last 2 years in a very meaningful way. There were 150 million ounces of silver in the COMEX warehouses 2 years ago. They're down to about 35 million ounces now of eligible silver for delivery. You know, the U.S. Mint has made 5 million silver eagles this year already. Right? They could wipe out that 35 million of eligible silver in a couple months easily. So there may not be enough physical silver. There probably will be enough physical gold for a while, but at a point in time, that's when the prices really just take off. Now, that's when we see an explosion of metal prices. And we could see a dislocation between what metal brings on the street versus what it's traded at on paper exchanges, on the futures exchange.
Right. Completely agree with that. I think the spot price is it's a futures, it's a paper price, a trading paper trading price. I don't think it's going to be the price that people will trade with when really things start to go bad. Dana Samuelson, before we wrap up, can you tell us a bit more about the American Gold Exchange and how people can follow or contact you?
Yeah, thank you. So we're American Gold Exchange. We're a national physical precious metals and vintage U.S. gold and European gold coin dealership in Austin, Texas. Our website is amergold.com. We have a very information-rich website. You can learn a lot about the different products we offer from our website. We have live, transparent pricing. We're extremely competitive. And I really only focus on the mainstream, competitively priced, widely traded bullion items. I could have 2,000 or 3,000 items on our website. We've got 200 or 300. And the reason is liquidity. You want to deal in what most other people will easily buy from you. So if something ever happens to us, I've always looked at our customers as our most valuable asset. And I've always dealt in the most widely traded, competitively priced, modern sovereign bullion item or refinery minted items because of liquidity for our customers in the future. Easy sellability, easy recognizability. So that's what we're all about, focusing on trying to help people understand why precious metals matter and helping them get into the right products. And there are some small anomalies. We can walk you through that, but we focus on what most people will want to own for a month, a year, their lives or their kids' lives.
Those are two great points. The right product and liquidity. I think sometimes people don't consider those things when they go into precious metals. But Dana Samuelson, it's been a treat to chat with you, and I hope we can do this again soon.
Patrick, I would love to. It's been great talking to you. I appreciate your having me on, and I'd be more than happy to come on anytime you'd like to talk to me. So thank you very much.
All right. Thank you also, Dana. That was Dana Samuelson, president of the American Gold Exchange, sharing his views on the economy and gold and silver. To learn more about Dana's views, please visit his website, www.amerigold.com. If you like this video, please do subscribe, share, and give it a thumbs up. Audio-only versions of this interview can be found on iTunes and Spotify.